In the wake of the devastating LA fires this week, get ready to pay a whole lot more for your home insurance in California. That is, if you're lucky enough to keep it. Coming up, I'll tell you why those LA fires might actually lead to the entire financial collapse of the California insurance market and what we're doing to try to prevent that. I'm Carl DeMaio, chairman of Reform California and a California state representative representing District 75 in the state assembly. For years on this show and through our organization, Reform California, I have warned about the pending financial collapse of the California insurance market. And no, it is not driven by climate change. According to liberal politicians and the media, they are lying when they try to say it's climate change. It is actually the failure of government. And you've been paying the higher prices as a result. You have been put at risk of losing your insurance. And that's even before the LA fires. But these LA fires, I consider them basically the proverbial nail in the coffin to the California insurance market. Already the insurance market was financially on the ropes with a lot of providers like State Farm, Allstate, the private insurance companies saying that they were canceling policies and leaving the state altogether, that they were having so many financial losses, they could not continue to operate in California and insure people. So as a result of that, the insurers got together and put together a plan with the politicians. And the insurers basically have said, we won't rat you out. We won't tell the public why we really are financially on the ropes in California. Your policies. More on that in a moment. And in exchange, you just got to do right by us. Let us increase our premiums. And so that plan was poised to be implemented by the Democrat insurance commissioner with the blessing of the Democrat governor and the Democrat supermajority in the state legislature. All of that was going to result in much higher premiums to you before the fires. But these fires are absolutely a megaton bomb when it comes to what the financial impact will be in the insurance market. To illustrate that in terms of what the costs are, let me start with the size of the losses. And again, these numbers are early and the numbers are going to continue to be updated and it's only going to get worse. But the latest estimate, and the fires are still burning, the latest estimate as fires are still burning in LA is that we are expecting to see about 10,000 structures as of right now destroyed. They're doing estimates, but they think about 10,000 have been destroyed in just the LA fires. That's going to go higher. How does that compare with other big fires in California's recent history? Well, the biggest fire, the Camp Fire in 2018, was 804 structures. I actually believe that all the LA fires combined are going to be on track to surpassing that. Because again, they're not contained as of the recording of this show. Then you got the Palisades fire already at 5316. But remember, there's other fires in the LA area that you could add to the overall impact of these regional fires. I was involved in the rebuild on two fires on this list, the Cedar Fire in San Diego in 2003 with about 2,800 structures, and the Witch Fire in 2007, about 1,600 structures that we had to rebuild. And let me tell you, we covered this in another episode of the show yesterday. Yes, losing your home to a fire is a tragedy. It is a nightmare. But there's a second nightmare that awaits a lot of these fire victims, and that is having to work with government and insurers to get their lives back in order and rebuild. It is going to be an absolute nightmare, and it should not be that way. More on that later. So let's talk about the financial impact of 10,000 structures or more. Here is an estimate from the insurance industry that was put out today. Insurance business, LA wildfires could cost $20 billion, doubling estimates. But that number is not the right number. Even in their story, they say that others have higher estimates. JP Morgan says it's $50 billion in losses. Another loss estimate came out from AccuWeather, not cited in this story earlier today, $135 billion to $150 billion of losses, of which 25 to 50% of those losses would be actual structure replacement. A lot of what the AccuWeather number has in it are disruptions of business operations, health impacts. By the way, a lot of the business operations, some insurance policies allow them to put in claims for that. So we need to get a sense of how big of an impact this will be to the insurance market. It's going to be devastating. We've never seen something this bad before, this significant. Remember, a lot of those Palisade homes, very expensive homes. When you take a look at the Butte fire, a lot of structures, and I think we're going to surpass it or at least match it. The replacement of those homes lower in value than what you would have to pay for some of these mega mansions in the Palisades. Now, who's going to pay? Not all those mega mansions are insured by private insurers. A lot of them are through something called the FAIR Plan, which is the government-run insurance program. Here's a headline from CBS News. Thousands of Los Angeles homeowners were dropped by their insurers before the Palisades fire. It goes on to say that about 1 in 7 of the homes in Palisades alone were government insured. The FAIR Plan, and I hope that none of you ever have to be forced onto the FAIR Plan, but sadly with this collapse of the insurance market, we may end up being in government-run insurance, which would be a complete nightmare. The FAIR Plan is the government-run insurance program, and it's paid for by premiums, which are much higher than the private sector premiums. It's about $3,000 versus $2,200 on average for private premiums. And then on top of that, the insurers have to kick in a bunch of money to subsidize. It's a double whammy. So people who are not in the FAIR Plan are paying premiums that ultimately go into the government's insurance pool to manage the losses of the California FAIR Plan. There are about 451,000 homes in 2024 in the California FAIR Plan, of which about 1,500 of those to maybe 2,000 of them, we have some estimates, were just in the Palisades alone. That means that the FAIR Plan has about $1.3 billion in premiums each year to work with. Remember those numbers I gave you earlier? 50 billion from JP Morgan, 135 to 150 billion from the AccuWeather team, 20 billion from the insurance magazine. Premiums for an entire year are not even going to satisfy the impacts of rebuilding, the financial cost of rebuilding in many of these communities. And so we have an insurance industry that was already in the red, already on the brink of financial collapse. Now you get a fire that's anywhere between 20 to 50 to 135 to 150 billion dollars of losses. There's no way. There's absolutely no way. And so let me just say this. When people say we can't blame Gavin Newsom, we can't blame Democrat politicians, the hell we can. When they preside over the collapse of an insurance market prior to a massive, devastating emergency and catastrophe like this, you damn right they bear a lot of responsibility. And as I explained in yesterday's show, there are 5 reasons why we can blame them. The conditions of the land and the habitat around these homes, where people were not allowed because of state and local environmental regulations and mismanagement to clear defensible space, where areas managed by government were not properly cleared of brush and fuel. It's a tinderbox. The fact that they didn't shut off the power. And people say, oh, well, that's the private sector. No. Los Angeles is a government-run electric utility. They were in charge of those policies. They didn't provide water to the hydrants. Oh, but Carl, they ran out of it. The job of our infrastructure department is to ensure that we are prepared for any eventuality. And by the way, we now have confirmation that they didn't have proper reserves in the tanks for those hydrants. We also know that they underfunded their fire department, $17 billion cut, but they had a $17 million cut, but they had enough money for $1 million of diversity, equity, and inclusion nonsense. And so the list goes on and on of culpability here. But on the insurance side, we also can blame the politicians for the catastrophic condition of our insurance market. No, it's not climate change. It is the loss value of these structures going up in smoke. When you look at the insurance market, they set their premiums based on what we call an actuarial model. It's done for life insurance. Actuarial models are done for pension programs to figure out how much money you get to collect for a pension payment in order to pay people out over the course of life for retirement. So actuarial models are done by a bunch of smart people with a bunch of calculators and math. And what they do in the insurance world is they take a look at the number of incidents that they are likely to have each year of losses, and then the dollar value of replacing the items that are lost that were insured. They add to that what we call overhead, operating costs of managing policies, and of course, a profit margin. That then gets divided into everyone they're insuring. You think that the insurance is based upon, well, what is your structure? That's how they divide everything out. But really, the way in which they set their pricing is dollar value of replacing all of the losses, the incidents that happen each year. Fires have not been the number one incident that insurers have to pay out for. Fires are actually pretty low on the list. They're very expensive because when you have a fire, it typically destroys everything. The number one incident for a homeowner is leaky pipe. But when you take a look at all of the incidents, whether it's leaky pipe or fire, earthquake, which is rare, when you take a look at where the actuarial models are off, it's not been in the number of fires. It's not been in the number of structures that are lost. It's been in how much it costs the insurance company to rebuild the home. So what's happened since 2020? Massive inflation has happened, particularly in California. And so with massive inflation has come higher lumber cost, higher electrician cost, higher plumber cost, higher carpenter cost. All of that is added to the replacement cost of building a new home. Oh, and don't forget, when you rebuild a home or fix a home that's been damaged, many times you are required to comply with new building codes that are in place today that were not in place when you built your original structure. And so all of that is added in to the cost borne. Some insurance policies don't cover it, some do. But all of that then is burdened to the insurance company in terms of these payouts. We know that the politicians are going to continue to blame climate change, when in fact the inflation side has been the real driver of the cost of the insurance industry that it's not been able to recover from premiums that it originally said. No one expected the massive increase in replacement costs. It was not part of the actuarial model, and now the insurance industry is trying to catch up. We now enter this final phase, and I consider it a final phase before the collapse, of a devastating, massive, very high value per structure calamity that's just going to push us over the edge. So what's going to happen next? Well, the insurance companies will announce that they do not have the financial reserves to pay out these claims. The FAIR Plan does not. I tell you right now, 1 in 7 people in the Pacific Palisades under the FAIR Plan, that's about 14.5%. There's no way that the government-run insurance program will have the money to pay out its share of these claims. And so a couple things will happen in rapid succession. Number one, you're going to see a massive increase in the people who are dropped in their policies, and they will then be forced into the FAIR Plan. As I mentioned earlier, the differential in price for premiums, private sector is about $2,200 per homeowner for insurance in California, and that's 2 years old data. That's going to be much higher soon. The FAIR Plan is $3,000 or above per unit, per structure. Many of you are going to be forced into the FAIR Plan. But the FAIR Plan itself won't have the financial resources to make good on its commitments, which means that they're going to go to the insurance companies, and the insurance companies are going to say, hey, we're walking out. We're not going to be part of backfilling your government-run plan. The FAIR Plan premiums will skyrocket even farther up. Oh, and then the remaining delta, the remaining shortfall, the politicians will say, oh, this is not a general fund obligation. This is a special outside the general fund budget obligation, which requires a special tax. So what they're proposing right now is at the end of each year, when you pay your insurance premiums, that there would be almost like in your mortgage, in your escrow account, a true-up payment that you make at the end of the year. Fortunately, your escrow company allows you to spread it over the following year's mortgage payments. Not what's under consideration by the government. The government's looking at a one-time penalty payment. They call it an emergency assessment. Well, it's not an emergency assessment if you know it's going to happen and it's happening every single damn year. You're going to see insurance prices triple in the state of California. Your insurance might go from $2,000 in a private provider up to $6,000 in short order. In the FAIR plan, you're going to go from $3,000 to $9,000. And that's just napkin math. I think it could actually be much worse. That is going to devastate people. I have not seen something this serious to homeowners since the 1970s, when we had massive fluctuations in property tax assessments prior to Prop 13, where your property tax would spike in one year and would force a lot of people out of their homes, particularly people on fixed income, retirees, losing their homes because they could not afford the local property tax assessment. This is all going to happen pretty rapidly in the next several months. Buckle up. Start saving now, because when you are presented with that cancellation notice, you're not given a lot of time to get new insurance. And then when you do find insurance, if you're lucky enough, you're going to be facing a massive premium. I'm sorry to say it, but you need to be ready. And I don't want you to be the one to bear the brunt. And so we've offered a plan at reformcalifornia.org, reformcalifornia.org. I'm going to take you to the page right now. Reform California releases a plan to stabilize insurance rates. And this is from July of 2024. Now we're going to have to update the plan even more aggressive. But I'm proposing that you not have to pay the higher insurance premium. I'm proposing that we give you an immediate insurance stabilization rebate. And you're going to say, well, where is that going to come from? My 4-point plan is, number one, slash the regulations that are causing the price of rebuilding and repairing structures in California. We need to have an all-out cost containment Marshall Plan in California, starting with the housing costs, starting with replacement and repair costs for insured properties. And look, if you can build a house in Texas for a third of the value, why in the hell can't we do it here in California? If they can do it, we certainly can. And don't let anyone in the liberal media say we can't. And don't let any politician say we can't. Don't let them say, oh, it's climate change, we can't control it. You can control the fact that it costs 300% more than Texas and other states to build something, to replace something. Second, fix fire management by reducing the risk to properties by clearing the brush, cutting those environmental regulations, giving people a de facto default right to clear 30 to 100 feet, a defensible space for their property, and mandating that it become an essential function of government to clean up their own land that they hold. Third, we need to stabilize rates. The best way to do that is to immediately cut and eliminate the $4 billion in insurance taxes that we collect on every premium. There's a state insurance tax, and I believe that as long as you're being price gouged, the government should not be able to collect insurance taxes for the general fund. That money should be eliminated and suspended, and frankly, we should rebate that money. And finally, we do have the cap and trade program with about $10 billion of climate change money. And I believe that since they're saying fires are caused by climate change, well, we'll take you at your word, at least when it comes to cashing the checks. I want all that climate change mitigation money to go to you, because obviously climate change is hurting you and we need to make you whole. Finally, I do believe that we're not going to be able to do this without some sort of federal aid. because the numbers are just so great. So I would urge the incoming Trump administration and the Republicans in Congress to consider a national reinsurance stabilization program. And this is on the insuring of insurance companies. Maybe we provide a period of time whereby the federal government, because of how bad the insurance markets are nationwide, but particularly in California, the federal government can provide a little bit of bridge financing, but it should be contingent, no blank checks. It should be contingent on mismanaged states like California getting its insurance policies to become rational and getting out of the nonsense climate change fetish, as well as mismanaging well and fire protection. Comment in the section below on this video on your thoughts on the insurance market. What has your premium done in the past several years? How much has your premium gone up by? Are you in the FAIR plan? How much did your insurance premium go up by there? Are you worried about being dropped for your insurance? We need to get the conversation going. We also need to spread the word and warn people that this is actually happening by going and sharing this video with all your friends. Finally, please help me in the fight to reform California's broken insurance system. Go on the website, reformcalifornia.org, chip in a contribution so that we can help advance this plan. We are making this an issue in campaigns coming up, and we can't use government money for that. It's got to be a campaign fund. Plus, we may have to put this whole program on the ballot in 2026 by collecting signatures and passing a citizens initiative. So chip in a contribution on that website, reformcalifornia.org. Until next time, save money because you're going to need it for those insurance premiums increasing. I'm Carl DeMaio, Chairman of Reform California and a California State Representative. Thanks for watching, and I hope you enjoyed this episode. But before you click away, please subscribe to this channel and click that notification button so you get updated when we post new episodes. Plus, like this video and share it with your friends so that we can help spread our message across the state. Reform California with Carl DeMaio is paid for by Carl DeMaio for State Assembly.